Hello guys, welcome to the Trading Parrot and to another elite workshop. This is the second workshop that we have organized around advanced trading. And you guys asked for it. You requested that we were going to do specifically cover liquidation pools and to cover as well order book. And in today's video we are going to focus on that. If you want to be part of these specific elite sessions, we are doing once a week on Thursday at 12 p.m. And today we were gonna do 12:30, but we started at 12. It's just a minor mistake. I hope you don't mind. And we are starting a little bit earlier. Today we basically have two fundamental pillars that we want to cover: liquidation pools and order flow book. We are going to go around all the different tools, all the different platforms that offer this data, and how do we use it, how to prevent mistakes. But the main question is, why moving away from technical analysis and using data-driven trading? Why caring about this additional, overcomplicated, if you want? Sometimes some people consider it overcomplicated to look into this. And I think the answer is technical analysis is the bread and butter of people that are trading retail. And institutions have moved out of the technical analysis a long time ago. During the 70s, during the 60s and 50s, where people were using pieces of paper to calculate RSI, to calculate the MAs, using technical analysis was still an edge. Nowadays, you can use technical analysis, but if you don't pair it together with some data, additional under the carpet, what's going on, you could get trapped into using just the technical analysis and being part of the herd, right? We see so often when the 4-hour produces a breakout and is confirming that the momentum is going to the upside or downside, and then suddenly something fails. We try to look into additional data to prevent somehow, in a way, that from happening too frequently. Okay, we will never find all the data in the world that we can consume to prevent every single fake out. Impossible. So it all comes together as a single kind of method to try to prevent risk and all of that. But one big pillar is to look beyond technical analysis. And I hope you are motivated to step outside the technical analysis only, to start building some big pillars when it comes to being a great trader. So let's start with the liquidation pools. What are we aiming to cover? We're going to cover understanding what are the liquidation pools, how to use them, prefer platforms. There's so many platforms offering, so we'll cover a few of them. Of course, we cannot go into all of them. It's just impossible. There are hundreds of them by now. Interpretation techniques, time frame analysis, and this is not time frame analysis for the candles. It's not just about that. It's also about the time span, how much data has been put together to calculate the pools, to use the heuristics and the algorithms to forecast where could these pools be. Yeah. The pros and cons about them, there can be also fake outs from the pools. There's been some situations that I want to cover so you are aware of them. If you're new to this, that's going to be really important. Common mistakes. And then in order book and flow analysis, we'll cover depth ratio, CVD, bar statistics. I'm going to primarily focus on things that have to do with Market Monkey Terminal, high block capital, CoinGlass maybe. And we're going to look into order book from different platforms because, again, every single platform is going to offer an overlap of these things, but many other things are going to be unique to certain platforms. This is where you start needing to also invest a little bit more, because having access to all of this information doesn't come for free. On technical analysis, you might get away with getting a free account on TradingView, to getting some open source tools to get technical analysis. But when you start consuming this sort of data, then you need subscriptions. Well, the good news is that in the description of my videos, there's always discounts and links that offer you lower prices for them. So have a look at them. Remember, this video is going to go live tomorrow publicly for free on my channel. But you are now here. I got you. Here are some comments from people. And if you want to be asking me anything and interrupting, if you have a question that you've been wanting to ask since forever about order book or liquidation pools, feel free to put it in the comments. That's why you're an elite member, so you can take advantage of that. So let's start with understanding liquidation pools, and I'm gonna come into this topic as if you never heard about them. I'm gonna assume that you are just technical trader, you know your RSI, your MACD, support and resistance and all of that, and suddenly you come across something like this, or maybe it's the first time that you are seeing something like this, and you saw it already and you don't know what is this. And basically, people, when they take positions on futures, not on spot, but specifically in derivatives, they have to they typically go with leverage, okay? Let's face it, most people on futures are going to use leverage. And I'm not talking about 1x, I'm talking 2x and beyond. It can even go to 150x. Some platforms are just crazy. And many people as well go 2x, right? But if they go 2x and they enter on a long, let's say they enter at 100K on Bitcoin on a long, and price goes against them, it goes 50% down, then if it uses 2x, where is the liquidation point? Where does this dude loses the account? Well, my answer to that, it will be, it depends. It depends on what sort of leverage the person is using. Is he using cross? Is he using isolated? So assuming the person is using isolated, that means that the what is it called? I forgot the name. I use it every day and I forget. Classic. The collateral is there for the position, and you use isolated. That means that the position itself, the amount of margin that you give to that position is available just for that position. Okay, so you open with margin of $300 and that's it. That's what you have. When you use 2x, you can get a position of $600 thanks to the 2x, and your margin is $300. But as you approach the 50% drawdown in isolated, that $300 is gonna double the speed to run out of margin, because you are doing 2x, so twice the speed as if you were doing 1x. And if you go 4x, is 4 times the speed of 1x as you run out of that margin. If you are 1x, in theory, you shouldn't run out of margin unless the funding rates end up eating you, or some other aspects that I ignore. That's why some people add margin to their positions on isolated. Some other people will go with cross, and they use the whole account as the collateral, as the margin for the open position. That's the one I use. I don't use isolated personally, but many people use isolated. I got nothing against it. I just became, more expert in cross than in isolated. Let me know in the comments if you are an isolated or a cross user. And basically, the margin, running out of margin, that is the liquidation of an account. It could be because of cross, you run out of the whole account margin, or if you are isolated, that position itself. It can also be considered liquidity. Where is the stop loss? So the people that calculate these charts, they need to be thinking on everything. How do we know where those accounts get liquidated, how much volume there is to get liquidated, and how much comes from account liquidations from cross, how much from isolated positions, and how much it comes from stop losses. I mean, I don't know how everybody calculates liquidation heat maps. There's so many platforms, and they have to basically use an heuristic to decide. We're going to scan Binance, Bybit, and we're going to look for all this information as much as we can. Some of that is public, some of that is not public. So they need to speculate some of the data. And that's why if you go to Trading Different, or you go to CoinGlass, or you go to whatever other platform that offers liquidation pools, also known as liquidation heat maps, you're going to find so many differences. Okay, there are differences that are coming from platforms, and there are differences that are coming from time frame. Okay, but let's leave the time frames later, because you can change these 3 months. You can make so many changes and everything is going to change. So you're going to find your pools changing places all the time. So it's good that we are in a workshop so we can discuss which one matters most and which ones are less important, less relevant, which ones are more reliable or not. If I forget to cover these things that I'm promising to explain, remind me in the comments. I will really appreciate that, because sometimes, as a parrot, I go in one direction and then I miss some other points that were also important. Before I continue, let me have a look, because there were some questions. So Steph is saying, excited for this, will be in a meeting, so a question in advance. Can you cover how you put together all these elements into making a decision about whether or not to enter a position? Great question. We'll cover that. And then Witnesium is saying, how do this comp see this info? Isn't it private? I'm not sure I follow that question. Can you rephrase that, please? And then the next one is, if retail is now a limit part of the market, how can liquidations be so significant? Are they using market orders as well or something? Okay, so I smell that there is a confusion there. Retail is now limit part of the market. Yeah, true. Retail is always part of the market. There are whales, there are big players, there are institutions, and liquidations are still significant because they expose themselves by thinking as a herd, as a group of people that think, here is my opportunity, and they go all in on that opportunity. And they tend to do things in an extreme way. They put a lot of leverage, they enter at the wrong time, and they end up creating clouds of risk. That's kind of a synonym for referring to liquidation pools. Liquidation pools basically reflect that too many people entering here in a short. Probably there was a spike in the open interest, and CoinGlass detected that, and it detected how many positions are open, an average of the size, and then they speculate that here there is a liquidity pool. There isn't really one there. We don't know. No one knows. No one has access to all the exchanges, to all the databases across all the exchanges to really map this in a real way. You can speculate that based on what you got. And some platforms do it great, some other a bit better, some others a bit worse. And you're going to find that they differ by a lot sometimes. So retail, yes, is less, but still enough to be very exposed. And whales as well, like, this dude, Win, I think is the surname, that appear in Twitter getting liquidated constantly. He made a few wins in a row, and then he got liquidated massively. He lost everything. So they also exposed a lot. They go 40x in one direction. They expect, here's the bottom, 40x, boom. And they bet all in one direction, and they contribute to the liquidity pools. So basically, once you get a directional move from an extreme, if there are plenty of positions open, still with that open interest app, then based on funding rates, based on number of longs, number of shorts, they can do some calculations to get a fair understanding of where could it be all that liquidity. There's also people that says there's no point on looking at this, particularly if you go into the long-term liquidations. There's no chance that you can really have a pool open from the 6th of August 2024 in futures, which is a fair, critic to using liquidation pools. But believe it or not, I've seen YouTubers, opening a futures position early in the cycle and keeping it open all the cycle. So we cannot really deny the fact that some people do that. Some people might still have this position open, and trading different is showing you here how it declines as well. For example, in here, I will say that around October, December 2024, it was peak, right? The fattest ever in this area. And then it started declining. Why is that? Possibly because they detected that some people were taking profits and then they declined it. So it's not fully true that all liquidity pools models with from different platforms are really that unrealistic to stick to a pool forever. On CoinGlass, you see things increasing. I rarely see something decreasing. So it could be that CoinGlass model is not as good as Trading Different. What I heard is that Trading Different was the first one, and I heard it from the CEO of Trading Different. Of course, he loves his own platform, but he said that we were the first ones. We were the first ones before High Block Capital. High Block Capital introduced one that looks really cool, that became really popular. So, for example, this look doesn't belong to CoinGlass. This is a copycat of what High Block Capital introduced with these charts. These charts here were the first ones I saw. I didn't see Trading Different before. I started with High Block Capital, and then High Block Capital became the monster that it is now. It's got hundreds, probably thousands of different metrics and tools and analysis and things. I really like the model of High Block Capital. I really like the model of Trading Different. I think they are worth paying for. The CoinGlass, the reason I like it is because it's the retail view of liquidation pools. Careful with that. That is the one that retail is seeing. That's the one that most large YouTube channels look at. They don't even bother to go to Trading Different or to use High Block Capital, which are paid, but in my opinion, their algo to calculate liquidity pools is better. Just my humble opinion, but keeping an eye on what retail is seeing tells me bias as well, bias of the herd, and do not underestimate knowing what the retail is thinking, what they are perceiving, and their sentiment, what is their alpha. That's what I like to be always aware of, for the good or the bad. There are liquidation maps as well. These are not heat maps, but they are also tracking liquidity pools. It's just a different slice of the same data. They also offer time frames. Let me see if I got a new question. Yeah, cool. How do they see my bets and my leverage amount? Isn't that private info? That's a good question. Unfortunately, in crypto, talking about private is really not something. It's impossible to now have privacy, really. You have on the blockchain every transaction. You cannot pair that to a name, potentially, right? That's a limitation to match someone with transactions. Maybe it's a challenge still. That's what the governments really want. They want everything KYC, everything behind AML systems. That's fair enough. But when it comes to mass data, you can literally, ask not ChatGPT, please. That sucks. But let's go with Code and you could tell it to, build me overnight something that goes into Binance, Bybit, pulls all the data that is free there, and build a model that creates every 24 hours a chart with liquidation heat map on the 1 day time frame. And I'm sure that you will get something out of that. It's that easy. It's that easy. It won't say, well, this position belongs to with Nesiam, right? It won't say that, but it will aggregate everything it's got. When you look at the open interest and you have a position there, that is partially you, okay? Funding rates as well. It's all aggregated. Then you got liquidations that you can see as events. You can see, for example, liquidationglass.com/liquidation data. In that URL, you're going to find on a per exchange basis, on a coin basis, which coins are being liquidated in the past 24 hours. I really like seeing the 1 million, over 1 million, what's getting liquidated on BTC. And then I get this color look that tells me, to be fair, most of the whales that got liquidated now were longs. And that tends to give me a bias towards, okay, we might get another wave to liquidate shorts. Not always the case, but more often than you think. And 12-hour here on the total liquidation charts, we have the 20 billion liquidation that happened 10th of October. Nothing even comes close. So all of these views of liquidations are also valid and very useful. And at some point, I need to come back to the question of how do I put all of this together. But before we get into putting everything together, let's see what's everything. So we got an understanding of what liquidation pools are. We know that they're calculated. We know that they are not real data that you can find in the exchange. They need to be processed with an algo, and there has to be some level of speculative analysis, some heuristic to complement data that really doesn't exist, to make decisions on where are those liquidity pools, how to use them. We talk a little bit about that. We talk a lot about that in the videos, but I want to bring it in again as a summary here, because this is a workshop and many people are not familiar with that. That's the whole point. So on trading, different liquidity pools work very different than on other platforms. You can pretty much get access to zooming in, out in any axis. And as you do that, I tend to have enable, which I forgot where it is, but somewhere in here, there is a toggle that allows you to normalize. They've been moving things a lot recently, so don't blame me, but somewhere in here, there should be something that allows you to toggle the normalization on and off. And I think the normalization is something good, okay? Because when I zoom out, I want to see in red the biggest of everything I have on the screen. If I zoom in, this red and that red, and notice that next to the price, there are no pools. But aren't, or are they? They are there. They are there. It's just that normalize against this big pool there, these ones do not appear because we have some coloring in here that needs to be respected. From very dark blue to very dark red, that is kind of a way of visualizing the biggest pool from the smaller ones. And in this area, it's saying that there is very little. Thanks God that there's two ways of visualizing things. So it doesn't mean that there isn't any liquidity because it's dark. It just means that there is so little that it cannot appear in the chart due to the normalization. Normalization means that you squash everything so you get a maximum, which is the red, and everything needs to adapt to a color in between. And if you look at this histogram on the right-hand side, that is the same data shown in a different format. So we got this way of seeing liquidity pools. You can see that around here there is, it's just that it's very little in this area as well. Now, if we zoom in and we leave outside of the screen anything that is red, still not, it doesn't happen. But as soon as I put that red on the lower end outside of the screen, we're going to get a new guy here in red. Why it became red if it wasn't red before? Again, because of the normalization. It means that now within this constraint of the screen, that is the largest pool that we can see in the screen. It's as simple as that. So how do I use this? Well, if I really want to see small moves, if I want to focus on scalping, on where is my risk in the short term, then I use short-term liquidity pools from trading different. And I also zoom in, leaving outside the major pools that are in the extremes. And when I say extremes, well, just to give you an idea, this red to that red, there is almost $30,000 of distance. So those are the major ones, right? You have a secondary pool in here at 117, and then there is all the minor ones that are not appearing because we are normalizing against the major ones. So in here, what is showing me is that we have that level there, and that is attractive. Red is attractive, yellow less, green less, and blue less. And of course, absence of any color means that there are very tiny fractions of liquidity relative to the rest of the range. If you want to quantify it visually, always keep that one on that side. So I still don't cover time frame, and I need to cover now this silhouette, which is offers you these settings in here. You're going to find 10x, 25, 50, and 100x. And on the top, we also see 10, 25, 50, and 100. Okay, what's the difference? And how did I get this pop-up? I click right there where it says liquidation profile. This guy here is called liquidation profile. Do not confuse it with volume profile. One thing is volume, another thing is talking about where are the liquidity pools. And I get it. If you're a beginner and it's the first time that you're seeing so many shiny things around the price, it's gonna get confusing. You're gonna find fair value gaps, you're gonna find liquidity pools, histograms, volume profile. Oh my God. So promise yourself that you're gonna take these things one at a time, okay? Because nothing worse than getting an overload in the brain of too many things in the chart. So if you're gonna go for liquidity pools, go for liquidity pools. If you, it's definitely a tool worth including in the arsenal once you have already conquered TA. And then you have fair value gaps that I consider part of TA. And then you get all the other books as well, which is part of data-driven analysis. I want to call it like that. Why not? Basically the 10x, 25x, 50, and 100x reflects what liquidation leverage the traders are using. So we could potentially focus just on the smaller number of liquidation pools. And I always refer to these pools, the 10x and less, as the pros. Ideally the 3x, okay? 3x are pros. These 3x's get liquidated way less often, and they tend to time things better, and their pools get breached less frequently, okay? As you increase the leverage in the pools, if you include all of them, you're gonna get everybody. And if there's a confluence, like you could disable these ones, identify what I call the degens, the people that go 100x. Those are really low-hanging fruits. They get screwed all the time, right? They got screwed down, this got screwed up, down, and down, okay? It's almost like the price is constantly in the scalping context, chasing high leverage, coming from dodgy exchanges that offer too much leverage. I need to be careful with that. And then the 50x, kind of puts some pools a little bit more away from the price because obviously it's less leverage than 100x. So they got lucky in here. They probably enter on this order block at 111 and then it came back down. So far, it seems that they are still holding those positions. But it could also be that new positions are entering. I need to think about that because if it's a 50x, how can they enter on a 50x from here on a new short and have their liquidation level there? The only way is if they use cross and they have a heck of a lot of margin. You know, there's so many considerations really to calculate these things. But let me focus on showing you the difference between all these levels of leverage versus the profile options, which are the ones in here. So you can do the same with the profile. You can enable 10x, look at the right hand side of the chart. I remove everything. I'm gonna put 100x. Now you're gonna see pools that belong to the degens, the ones that get hit all the time. Then the 50x, then we add the 25x, everything gets normalized, and then the 10x. So by moving the leverage, by focusing on the low leverage, you focus on the winners, the areas that eventually are gonna get hit, but they get hit less frequently. By focusing on the 150x big leverage, you're focusing on the losers that, you know, they get it wrong all the time. You know, that those are our exit liquidity, basically. And yeah, I wanted to talk about the time frame. I think that comes next before we make this full workshop only about liquidation pools. The time frame, very important. So on trading different, you have scalping and you have swing. And these are two different engines calculating in a completely different way liquidation pools, one for the long term, one for the short term. But within each option, so if you go to the swing one on Bitcoin, you are still gonna get time frames, daily, 4 hour, 1 hour, 15, and 5. Confusing, really? Yes, because swing is calculating with a different engine, different software that focuses on long term. That's why I use it with the daily. And then when I go to scalping, on my scalping version, I keep it in the 50 minutes. That's just my preference to catch the daily moves and to catch short-term liquidity, but I still get the option to change time frame in here. You can compare them side to side and see which one you prefer and why. So time frame, what does it matter about the time frame? It matters because the time that it goes back, the what is it called? The length back in time to accumulate, to aggregate pools and information is obviously shorter in the scalping version versus in the swing version. That's why it will only catch moves of the price that happened recently. And if you go to the swing, it will catch pretty much everything. What is missing on the long term? Well, it's missing everything that comes from the previous cycle, because as you can see, it gets up until January 2022, and that's it. And indeed, it needs all this period to start calculating the pools in here. So even though you see the price, you are only seeing pools from August 2024. These pools were calculated on everything that happened there. Okay, got it? So for example, price went into 74K, some shorts entering here, those were in the database, and then they speculate that those created these pools and they got hit. Now we have a collection of long-term pools that I give them numbers, 1, 2, 3, 4, 5 to the downside and 1 to 3. That's a good practice as well. So you can talk about them and discuss and have mind arguments of which one is going to be first, what order, and whatever. Pretty cool that you can do this not just on Bitcoin, but also now on Forex, on ETFs, on stocks, on everything and trading different, and on separate exchanges, not just on Binance, but also Bybit, BitMEX, and Deribit, which offers options Okay, so there's too much information there sometimes to analyze everything, but there is an overload of information on trading different. If you are up to give it a try, check the link in the description. So on CoinGlass, you can also modify the time frame. It gives you up to, I've seen up to 3 years. Now I'm seeing just 1 year. I don't know, maybe it's paid the option of 3 years. And you're gonna get higher time frames, like 1 year only on Bitcoin and possibly Ethereum and the top market cap. But if you go into all coins, the shittier the coin is, you're just gonna get 1 month. Most of them get 3 months. And they pretty much take all these 3 months and they see everything that happened in the price and they speculate based on what time frame you're giving. All right, so let me see if I complete everything. I think I just need to give it a little bit of go in how to use them and then the pros and cons. And, you know, it is what it is. If I don't do fully order book today, we can do it next week or another time. I'm not going to get stressed. I want this workshop to be ultimate guide of liquidation pools. If we cannot cover order book, so be it. A better quality than quantity, in my opinion. And if we go now into any of these pools, how do I use them? Whew, that probably is the longest conversation that we can ever have. We can probably go to, you know, a few drinks and come back the morning after and still have to repeat that for 7 more days until I really say everything I need to say about liquidation pools. But if we want to say the big highlights, what is the most common thing that people say about liquidation pools? That if you are very close to a liquidation pool, if just pending there becomes a low-hanging fruit, and it's very likely that you're going to hit it. This number 2, for example, is low-hanging fruit in the long term, or this 97 is a low-hanging fruit at the moment on the shorter term. So we should, in theory, go for them, right? Right? Not so sure. There are exceptions. So the rule is, yeah, we go for liquidity pools, sure, but there always is some room for exceptions to the rule. And the exception is suddenly you get an insider, a big whale that enters in a position and it flips the whole thing. And sometimes they have used pools as a tactic to say, let retail think that we're going to number 2. We're just going to buy the heck in here and we're going to go straight for an all-time high. And they leave you hanging. Okay, I don't know if I have examples, but you know, in any range, you're gonna get big pools being hit. Unfortunately, we lost these ones. They were very red. And we left 47 for later. That is still there, is declining. And then we got these pools in there that, you know, when you were trading at 75, you probably were freaking out that there was a massive pool at 67. And then you keep thinking that you're gonna have to go there. So the rule of thumb is understand the positioning and the sizing of the pools as part of your chessboard, okay? But when you are playing against someone, you cannot read their mind. Even if something looks like the guy is gonna eat your pawn and is gonna hit it, at some point he might be just using it for spoofing, for bluffing, for tricking you to believe that that is the obvious move. But that's an exception. I insist, that's an exception. Most of the time we identify pools. If we see a breakdown, we start smelling that they really want to go for that and they end up going for that. And then we say, yeah, they went for the pool. Now we have this pool in here, and you also have to consider that pools decline through the bull cycle in size, the ones on the top of the price. Every single impulsive wave up had pools that had tons of people convinced that we were going for 6K, and they were massive. And then they got liquidated thanks to all these moves up. These were just liquidating people. And these ones were liquidating people. These ones were liquidating people. But on each wave up, they declined. There were less people willing to short. And here, guess what? There's more people willing to long relative to what we used to have before. And they're long in there and they have 2, 3, 4, 5. One is larger, is concentrated there, and there is a potential to enter a bear market leaving behind one of the pools, in which case, those guys are going to win big, right? But there is a chance that they can get away with that. But number one, if we leave it behind, just be aware that this one is probably, let me guess, 30% or less the size of this number one in there. Just so you know. So motivation to go and kick out of the way one before going down is less than it was in here to kick 1, 2, and 3. That is very important. So yeah, I use them to basically combine with other indicators to understand motivation to go in a certain direction. And even if we have full confirmation from many indicators, sometimes direction is wrong. But for example, you've been falling like a knife and there is some bottom informations and suddenly too many shorts enter, they're going to leave a cloud there. And that is kind of low-hanging fruit. And I chase those things and it works really well. Even if I need to average down one time, worst case scenario. So yeah, it's still a great tool. Pros and cons, common mistakes. Yeah, I mentioned a few common mistakes. People assuming that a pool is like a religion. There's a pool, we have to go there. That is the biggest mistake. Certainty doesn't exist in trading. So not taking it with some risk management is the most common mistake. The pros and cons, it's this thing that across different platforms, they're different, that they're not really fully realistic, that they make mistakes, that sometimes we don't go for the pools and stuff like that. But I think overall they have massively add to my arsenal of tools. Now we can go a bit into order book. Let me see the questions. Command button on iOS to normalize. Yeah, you can normalize on iOS. I couldn't find on the web. I think I'm concentrated on the workshop, but I will find it later. So that's the last question. And I'm going to go now with the order book. And probably, since we only have 15 minutes, I'm going to have to take some of this into a third session of the workshop. Remember that if you want to watch the first episode, you can go, I think it's in one of the lives. So 13 days ago, we have the previous Elite Private TA session, and it's live, it's public, it's free, it's 1 hour. You can watch it right there. That's episode number 1. And the one we are recording now is episode number 2. Episode number 3, if we need one, which I suspect we will, it's going to be next week or at some point. I will ask, obviously, my Elite members whether they want it next week or if they want TA. So we got a bunch of elements that qualify as order book, order flow, information, additional things that are not there on TradingView in general. I mean, some of them are, but in a daily time frame only. So kind of the shitty version of that data. You can find funding rates, you can find a few things, open interest on other platforms, but careful, because sometimes they update it once a day, it's delayed, their updates. So if you are going to step into order book, for studying, for paper trading, use poor data, low quality data. Don't pay for the data. But if you're going to make stupid money, pay for actual data and check that the data is being updated by the minute, that is consistent, that it makes sense, before you step into a trap of data-driven that is trading that is lying to you. That is worse than not using data. Depth ratio, we got the CBD, bar statistics, net longs, shorts, open interest, funding rate, order, heat map, and volume profile. So I'm going to do something. Elite members, you're watching this video, pay attention in the screen, choose one thing that you want me to do next. And the first one that writes it down, I'm going to do that one. And so I'm looking now at the comments, whoever writes down which order book wants me to do it first, I will do it. And then I will use the other ones to try to complete. In the meantime, I'm going to load high block capital. I'm going to need this one. I'm going to need fire charts. And we're going to need Market Monkey Terminal. Right, so we got net longs shorts. You're still not late. If you want to write down another one, you can write another one, and I will go to that after net long shorts. Net longs and net shorts on a Market Monkey Terminal is an amazing tool that reads obviously into the order book. This is the order book. I'm currently loading just Binance, and I have the placement of the limit orders are across the range of the price. We are trading at 103, and we can see where we have stacked more orders. I put this to 500. By default, it might be $1, but on Bitcoin, $1 is nothing. So you can see here that there are some orders. I have it set to coin. You can set it to USDT as well. But by putting custom and then writing down 500, I can see more of the range. That's the only way I can get to see 112 and notice that there is some big resistance of big sellers on Binance. Now, going back to net longs and shorts, you look at the order book. That's why I explain what it is. And they estimate how many people are in a long and how many people are in a short. And there's a cumulative, there's a net delta, and I suspect that they calculated somehow together with the open interest and maybe using the funding rates. And with the funding rates, maybe, I'm just speculating, but maybe with that, they can tell whether that open interest overall, the total amount of open interest, this portion belongs to net longs and this portion to net shorts. And I don't know, but hopefully they do it cross-exchange. This doesn't say, but if it's cross-exchange, it means you have a visualization of how many longs have entered or exit the market. And this combined with seeing the open interest, which tells you, how many futures positions are open, and together with the liquidation events where you see longs liquidated or shorts liquidated, it gives you a perspective of how people are being liquidated, taken out of the market, and then you get less shorts or less longs. Also, when you see the open interest spiking up, you expect volatility, but you always want to know if it belongs to net longs or if it belongs to the shorts primarily, because you want to see who is increasing that open interest, who's entering so many positions at the moment. And since it's open interest, those are positions that are not just limit orders, those are actual positions. They are already running, they're burning funding rates already. And those are the ones reflected in here. When I see a move down in the price, I want to see the net long starting to build a move to the upside. That's kind of my wish when I want something to revert to the upside. I want to see that the net longs are entering. And when I come down, I also want to see, for example, for a move up, I want to see as we go down more shorts entering as well. Why you want more shorts? Yeah, because I want to liquidate them, right? When there is a scenario where there is an overcrowded trade direction, like too many shorts incrementally entering as the price goes down, that's how I understand, in one way of understanding, that there's an overcrowded territory for the shorts and that potentially we can go up. You can infer it from that way, which is a bit complicated, and I understand sometimes you tend to think it the opposite way. Oh, there's more shorts, we're going down. Not necessarily. It can be the opposite, right? And better ways to understanding that is if you look at the delta, for example, the short-term delta, if you're scalping, seeing a big cloud in here, that tells me that there is a lot of longs in the close proximity to the price, and the longs are about to get hit. And that was the case when we were trading at around 106. And then when the price going back into almost 101, they got all taken out of the way. And now we got a delta that is flat. And on Market Monkey Terminal, that flatness doesn't necessarily mean that all longs and all shorts, net longs and net shorts, all of them close the position. It could mean that they are just in an equilibrium. There is same amount of longs, same amount of shorts. In which case, there's similar amount of liquidations up and down potentially. All of that is important. Then we have another question. Michael wants to know about funding rates, and funding rates are very interesting. At the moment, you can get funding rates from many different platforms, many that are free. I've got them in here in High Block Capital, and I made it part of this chart. I don't know why, don't ask me why. But if funding rates go very low, that means that it's in the negative, and there are too many shorts entering there. And if you find that situation at the low of a price, so you got too many shorts entering when the price went too low, from here we went from all-time high into 103. That is a move of 23k. Okay, big move. And these people don't understand that price eventually needs to do a swing up, and they go all in, and that puts the funding rates across multiple exchanges. You have CoinM, Binance, USDTM, Binance, BitMEX, Bybit, Deribit. You have all the exchanges, and combined they are negative. Everybody is shorting this thing, and they get liquidated. There's always a move back into the mean at some point when there is an extreme situation, and that can play out in both directions. It can be funding rates are too positive or too negative, but the best way that people trade funding rates as a trade, just think about someone that is focused mainly on funding rates and he doesn't want to combine it with anything else. One typical strategy is to say, where are we in a bull market? Right. Wait for funding rates in negative and take a long. Yeah, that works. Yeah, it does. It's as simple as that. Many people do that. And they wait for that. You get extreme fear. If you want to put another layer on top of funding rates, just not to trade so naked on funding rates, but extreme fear there and funding rates negative is a good combination. There's many other combinations. Like I love the longs versus shorts in here from Binance, particularly crossing beyond 70%. Poof, it works like a charm. Sometimes it goes beyond the level of 70. Like here, it started going over 70 from a price of 104.7, and you made a move to 98, and it peaked at 74 almost. All this move up contribute to producing some cushion in the price for the price to revert back up. We did not have negative funding rates, as you can see. So you do not need funding rates in the negative to go up. Neither you can only rely on a over 70 longs versus shorts to produce a bottom, because this moved down 6k from the time it was 70. So it's not the perfect signal. So those are very important. And I'm going to cover one more. I'm going to have to remember this for the next workshop. What did I cover on the order book? I cover longs, shorts, and funding rates. One more could be, let me think, the order book heat map. Yeah, let's cover that because it's related to what I already covered. I already covered the order book. But there's other ways of visualizing this. In here, you visualize it by exchange. You can add as many exchanges as you want in here, but I keep just Binance because, it's too big to ignore. And it gives me already kind of an overview. But on a Market Monkey terminal, you can aggregate 13 exchanges and give you a heat map representation of this. This is just how it looks now by the second. In here, there's like a view that shows you the history, right? Like there was a big area there with 1,000 and then it got moved up. So you see the full history. In here, if this moves up 2 hours, you're not going to remember that it was before at 112, but in here you will. So that's called heat map SD, and you can enable separate via spot or via perps or coin perps and what type of position or what exchange you want to cover. I keep them all on because I want to see the aggregated order book history. What are they doing? I care if these things are being moved, shift up, shift down, if they're chasing the price down, if they are building a cloud of support there, which is completely related with the bid versus ask, also known as order depth ratio. That I go nuts with that because I love it. Initially, I was just doing 0 to 5% deviation, calculating how much orders, limit orders are above versus below in a 0 to 5% deviation up and down, and getting this ratio. And every time I crossed this line, it was a long, and every time it was very low, it was a short or whatever, or maybe the opposite way. But then I started slicing by chunks of deviation, 0 to 1, 1 to 2, just to understand, to get a history of what happened really with more granularity than just seeing this. Because in here, I cannot do a ratio. I see lots of lines, but it's difficult really to say which one is heavier. And by the way, Market Monkey Terminal has also liquidation heat maps, which the owner, the CEO, promised me that this is definitely the best in the market. I haven't used it, to be honest. And I guess if you change the time framing here, it's going to track longer back in time, just like trading different. Let me know if you have used it and if it's good. You can change the colors, and you can include exchanges or different excess of leverage as well. Change the order flow, extend levels. There's so many settings. Market Monkey Terminal is fantastic as well. But you kind of get used to your usual tools, and all this sometimes I change. Notice how they put orders at areas of big volume. This is the volume profile, which we haven't covered yet. We can leave that for the next session, but notice how they defend that. Point of control above is bullish, below is bearish, and they put an order right there to basically short resistance. I mean, have you ever heard about that? It's the most common thing. Shorting resistance, longing support. And that's what they're doing. Support, they think it's around here. Resistance is in the point of control. All right, guys, we have come to an end. Thanks so much for being active part of this Elite Live workshop. And unfortunately, we couldn't cover all the topics of the order book. And I have a tough time trying to put everything I want to say about each individual topic, and it's so difficult to stay in track. But probably if you want me to complete the order book workshop, putting out a 3rd episode live for Elite members, probably we're going to send you a poll by Monday asking you what you want to do, and then you can decide whether next Thursday you want TA on all coins or if you want more of this, and then I can complete all these topics, and that will be fantastic. Whichever you prefer, I'm fine. And if you are watching this on a Thursday, on a Friday, that means that you're not an Elite member, you're not being part of these live events, you're missing out. We're doing a lot of things here. And if you want to be part, there's a link in the description to join my Patreon. Just make sure that if you join as an Elite. That is the top tier at the moment. That's going to give you absolutely everything we got to offer in this community, which is a lot. Thanks so much for watching. I'll see you in the